Okay. Okay, we've just gone past 4, so I'm going to get started. We are recording today as well, so so anyone that comes in or joins us late will be able to look that up as well. But welcome. Today we're going to talk about what is the MAAL, the Multinational Anti-Avoidance Law, and what do you need to be looking for. So let me just give you a quick introduction on Transfer Pricing Solutions. My name's Shannon Smith, so I'm the founding director of Transfer Pricing Solutions. We really pride ourselves on providing practical and proactive and cost-effective transfer pricing advice. And we've got a really experienced team and a great global list of clients. We work with companies directly, but we also work with a lot of accounting firms to help them provide transfer pricing services to their clients, because obviously it's quite a specialized area. All of us have a Big Four background, and being able to help other accounting firms in fully servicing their clients as well. So we like to provide proactive advice, and also this very practical, because often there's a lot of work that's required in transfer pricing, and it's not always a company's number one priority, but trying to make sure that they can balance their risk with the cost as well on that. Just a bit about our structure. So what Transfer Pricing Solutions, I founded Transfer Pricing Solutions back in 2007, I guess you could say from my home, as a lot of us do with small business. Who would have thought there was such a demand for a specialized transfer pricing practice and outside of the Big Four. We've been operating in Australia since then. About 5 years ago, we set up in Singapore. That was based on demand from our clients to get that kind of services. And in the last few years now, we've set up in Malaysia. So we've got team members in Singapore and also Malaysia. And obviously here in Australia, it does mean we can provide a very seamless transfer pricing service, not only just in the Asia Pacific region, but also globally as well. Just a bit about some of our recognition. We have been recognised as a Tier 2 transfer pricing advisor in both Australia and Singapore, ahead quite a number of very good firms as well. So we're very thrilled with that. And we have been winners of many of the Asia Tax Award transfer pricing teams of the year, and also at the Australian Accounting Awards as well. So just to introduce who you've got here today, and I think that HC's picture just disappeared on when I put it up, but you can see him in person. Yeah. So myself, Shannon Smith, director, and Kevin, senior manager, and also HC, a senior manager, and both of them are here in Australia with us. But we also have our teams, as I said, in Singapore and Malaysia as well. Everyone comes from a Big Four background, and you'll see HC live because for some reason his picture disappeared. But what I want to go through today with you is, well, what is the MAAL? And there might be many of you that hear about this law or not. And I find often when we're talking with companies or accountants in regards to their clients, many of them think, oh, it probably doesn't apply to me. That's probably one of these big company issues. And maybe that's that smaller company here in Australia it doesn't apply to. But unfortunately, it does apply to a number of those smaller subsidiaries here in Australia as well. So we want to go through what is it, who does it apply to? And then how can we assess our risk? And then what guidance have we been given by the ATO? And then we'll finish off with how can we help you in going through and dealing with the MAAL. So what is the MAAL? What does this mean? And it's kind of not the greatest acronym when we hear MAAL, but it's the Multinational Anti-Avoidance legislation. So it was brought out in 2015, the tax law amendment, and it's really to combat a lot of this multinational tax avoidance. So a lot of you may have heard about the BEPS initiatives, the base erosion profit shifting, which is more of a global initiative that's going on. And it's really about combating erosion of the Australian tax base. It applies on or after 1st of January 2016. And so it has been around for a little while now, but I'll have to say that probably the knowledge of many finance tax directors working in companies and accounting firms, it's probably not something that's always come across their desk to realise the significance. I know when we talk with overseas companies that may have a subsidiary here in Australia, and we raise the concern of this legislation, a lot of them haven't heard about it or not realised that Australia has this, I guess you could say, special form of legislation over here. So to apply, you must have entered into a scheme. Now, part of the issue with that is that not everyone would have thought it was a scheme when they entered into it. They entered into an arrangement, but for tax reasons, we call that a scheme. And it has to have a principal purpose to obtain a tax benefit. And then what happens is that we tend to treat the MAAL schemes as a deemed PE arrangement. So when we're looking at that, I guess it applies to what we call artificial schemes that are put in place to escape paying Australian tax. So the MAAL tends to target multinational entities that have, for example, avoiding a taxable presence by undertaking, for example, a significant amount of work in Australia in direct connection with, say, an Australian sale, but booking their revenue offshore. So they actually have a lot of operations going on here, but the revenue is booked offshore. And there can be a tax benefit, can also include, say, reducing or even deferring a tax, the tax liability potentially under the foreign law. And that the core or the goal of it was to actually avoid Australian tax or reduce their foreign tax liability. So the onus is actually on the taxpayer to prove that the TP arrangement was not made for the purpose of obtaining a tax benefit in Australia or abroad. And really, if you do get caught under the MAAL, the Commissioner can deem all of the income derived by the foreign resident from the sales to Australian customers to be made through a PE or taxed in Australia. So this is where, and Kevin will go through this a bit in a bit more detail, is where we're looking at what is the principal purpose of what the structure is and how you've gone about going to looking at it. So if we go and have a look at then who does it apply to? So what is it? It's looking at a scheme in place to basically reduce the Australian tax that's paid here. But who does it actually apply to, and when should you be, in a sense, concerned or looking at it and making sure that you're considering whether the MAAL applies to you? So it applies to those that are significant global entities. Those of you that joined us for the country by country, I talked a bit in detail about what a significant global entity is. So if you're, and do note that the definition of a significant global entity has actually been broadened recently to include entities that are not necessarily consolidated to their global group for accounting purposes. So there is a wider net on that. Now, those at risk are those that have entered into a scheme resulting in avoiding a taxable presence in Australia, revenue being booked offshore, and the principal purpose being to obtain a tax benefit. Now, it is important to note, and as I said, Kevin will go in a bit more detail, that there will be structures that are potentially at risk of the MAAL applying, but it really comes down to what are you doing from a commercial perspective? What was the principal purpose of the way in which you've structured? So some of those that I would say, where might be some of those red flags or types of clients that if you see this structure, whether it be your own business, the own business that you're the finance tax director for, or whether it's one of your clients, where you have a situation that, for example, might be a foreign subsidiary here in Australia. The sales are made to Australian companies by, say, one of the parent company or one of their other related parties, and the sale entity here in Australia is actually not the one selling the goods, but is purely just getting a small service fee for its role in that overall transaction. If you see a transaction like that, that's where you want to say, well, actually, we could be at risk here. Is that going to be an issue? So I'll pass on to Kevin to talk a bit about how can we assess our risk.
All right, thanks, Shannon. So now we know what MAAL is and who it applies to. How can we assess whether or not we are at risk? The answer is quite simple. We just look at what are the criteria that need to be in place for the MAAL to apply. If we do not have any of those criteria in our structure, then we will be fine, right? So what are these criteria? Now, some of these have already been mentioned. First, you need to be an SGE. You need to have a foreign entity supplying directly to an Australian customer. It can be products or it can be services. You have an Australian entity providing direct support. This usually is in the form of services to your foreign entity. The income derived from the Australian customers, they are not taxed in Australia. And lastly, the principal purpose. If you are deemed to have a principal purpose to obtaining tax benefit, then you will be at risk. I think the past few points are quite straightforward. We can work this out easily. What we often get asked is the principal purpose. How do we determine whether or not we meet this criteria? Okay, the answer is simple. We do this through a principal purpose test. What this test is basically doing is to see whether your group has set up a particular structure or arrangement in place to obtain tax benefit. Now, the terms of principle is not specifically defined in the Income Tax Act. However, the ATO mentioned through their guidelines saying that the principal purpose test should be consistent with the approach taken by the OECD under their BEPS Initiative Action 6. What does this mean, right? It means that basically if obtaining tax benefit is one of your purpose of setting an arrangement, it doesn't have to be a main one or a sole dominant purpose, you would have failed this test. If some of you remember, there is this sole or dominant purpose test in the old anti-avoidance law. Now, this is a bit different from the principal purpose test in a way that, the principal purpose test is much lower threshold, has a much lower threshold, because you don't have to be the sole dominant. It doesn't have to be a dominant purpose to obtain tax benefit. It can be any one of your main purpose to obtain tax benefit for you to fail this test. Now, of course, doing all these tests can be very subjective. After all, this is a risk assessment. But as a general rule, if your arrangement is set up in a way that looks more like you did it for tax benefit, or that it is clear that your group has already received certain tax benefit as a result of this arrangement, then you will be deemed to have failed this test. Okay. When we look at timing, when do you need to do this? If you think that you have certain MAAL risk, you want to do something about it, but you don't know when you should do it, you can either do that. There's no clear rule that say when you need to do it. The ATO say you can do it either at the time you want to put in a certain arrangement or structure in place, means you can do it contemporaneously, or if you already have the structure in place, you can do it as you have carrying out this structure anyway. Okay, now after the risk assessment, if you think that yes, I might have some risk for MAAL, I want to know what is the financial and tax impact to me if I'm caught under the MAAL. So basically, if you can go to the next slide, please, Sheldon. The next one, yeah. So there are a few things that can happen if you are subject to MAAL. First, it is likely that the tax benefits you have received under the particular structure will be neutralized. Now, what type of tax benefit, you may ask? This generally involves the income that are not taxable in Australia, meaning the income, the Australia source income that are retained offshore as a result of this arrangement. That is one of that. And then any potential withholding tax associated with this income. Now, this withholding tax issue is more relevant to when you have a royalty arrangement that is directly linked to the supply to Australia. We will talk a little bit more about that later. So how would this work? The MAAL legislation gives power to the commissioner to recharacterize your arrangement based on a hypothetical arm's length condition. In other words, the commissioner may say that independent party would have supplied the Australian customer through another method, maybe through a permanent establishment. It will not put the structure that you have in place right now, but doing through a permanent establishment. This will then, if the assessment was made and justified by the commissioner, then it will create a notional PE in Australia, and then you will have to work out what is an arm's length profit that is attributable to this PE. Now, how the attribution of profit works, on a high level, it looks into the functional asset and risk profile and contribution made by both your Austrian entities and your overseas offshore entities across the supply chain to Australia. From there, the proceeds from the Austrian customer will then be attributed across the relevant entities based on their contribution. In addition to adjustment, this it also can create some other tax obligation, like as I mentioned earlier, withholding tax. This is relevant where, for example, you have a royalty payment attached to the sales generated from the Australian customer. In the past, under your structure, all this profit is channeled or retained offshore, and then the offshore entity will pay a royalty payment to another offshore entity. So this effectively avoided the royalty withholding tax in Australia. So that is something that we need to consider as well. So obviously, it's not all doom and gloom. There are some exceptions to this. MAAL did provide the commissioner power to make what we call a compensation adjustments. This basically just gives the commissioner to exercise his discretion to reduce the amount of adjustment made under MAAL if he thinks it would be fair and reasonable to do so. However, I think in practice, unless you have a very good commercial reason in place to support your argument, we don't expect this to be given out often. Okay, so now with the risk assessment out of the way, we have come up with two examples for you, just to show you what a high risk structure would look like versus a low risk one. Okay, if you look at first the high risk structure here, this is quite a complex structure. You have your parent entity. Now these are all SGE group. You have your parent entity entering into a cost contribution agreement with a subsidiary. We call it a subsidiary A for this purpose. And this subsidiary is in the tax haven jurisdiction. Subsidiary A then licenses this IP to subsidiary B, and subsidiary B enters into contract directly with the Austrian customer, and they supply them directly as well. It pays a royalty to subsidiary A for all sales made to the Austrian customer. In Australia, you have an Australian company that perform high value adding tasks that brings in customer contracts for subsidiary B. Now, what is high value adding tasks? It can be different from case to case, but it generally involves high value sales activities like contract negotiation, contract renewal, upselling, cross-selling of products, helping customer putting in purchase orders, and then from there, the income derived from Australian customer are retained in subsidiary B and not taxed in Australia, while the Australian company only receive a routine cost plus return. Now, if we take a step back and go back to our risk assessment criteria that we talked about earlier, go through each criteria and then we will get an idea on how risky this is. First of all, you have a SGE group, check. You have an offshore entity supplying directly to Austrian customer, check. You have an Austrian entity providing direct support to subsidiary B for the supply, check. The income derived from the Australian customer, they are not taxed in Australia. Then check again. So the last one that you have is the principal purpose. When we look at principal purpose for this structure, it is quite visible that the structure provided a few tax benefits to the group already. First, you have an Australian entity that takes on high value activities, similar to what you would expect from, say, you have a distributor or primary service provider if it's a service here. However, here they are not entitled to any income generated in Australia. Second, you have also royalty payment that is connected with the supply to Australia, but these royalty payments are not subject to Australian royalty withholding tax as a result of this arrangement. Now, you combine these two benefits together, and the structure it is likely that this structure will fail the principal purpose tax under MAAL because of the inherent tax benefit they receive. Now, on the flip side, if you look at a low risk structure as a comparison, now you have this structure is less complex than the previous structure. there's no complex royalty arrangement offshore connected to the supplies to Australia. However, you still have the offshore entities supplying directly to Australian customer. The income derived is still retained offshore. However, the big difference here is the Australian company is not involved in high value adding activities. They are only providing general marketing and customer support services. If we are to do a contribution analysis, it could be the result will end up the same. They probably would have been getting the same reward as a cost plus arrangement because all the high level activities they are done offshore. Okay. So once we go through that, the ATO, if you want more assurance, the ATO actually provided more guidance on how we can assess our risk to MAAL. This we will go through by my colleague HC. That will give you a bit more details on what the guidance ATO guidance is.
Thanks, Kevin. All right. Let's talk about the law behind MAAL. It's all about understanding what the ATO thinks, what's the ATO stance in MAAL, right? So the ATO issued the we call it Law Companion Ruling, LCR 2015-2. It provides guidance and assurance to taxpayers on an acceptable approach by the ATO in assessing your MAAL risks and exposure, right? The LCR highlighted several steps relevant to assessing whether first, you need to consider the application of MAAL, right? That's the first step for your transfer pricing structure. Then it's very much dependent on your specific facts and circumstances of your entity. Now, the LCR sets out a series of questions that taxpayers should consider in assessing the application of MAAL. These questions were, they're structured to assess three key aspects of the scheme, right? First is the direct connection between the Australian taxpayers and the Australian supply. Secondly, will be the commercial dependency of the Australian taxpayers. And lastly, will be the purpose of the scheme, right? So on the next slide, I'm going to go through the list of framing questions recommended by the LCR 2015-2 for risk assessment purposes. As I have mentioned earlier, the first of the key aspect is actually direct connection between activities undertaken in Australia with the supply to customers in Australia. Right. For this question, we need to consider the nature of the Australian activities in relation to the Australian sales, to the extent of the responsibility of the Australian staff in respect to contractual and commercial negotiations with the Australian customer. And also, you need to look at the level of day-to-day contact between your Australian staff and the Australian customers. Right. Next, we have the commercial dependency aspect, whether the Australian activities are associates of or commercially dependent on the foreign entity. Right. Here, we have to look at whether the foreign entity sells directly to the Australian end customers through, let's say, independent Australian sales agents, whether there are other related Australian entities that are involved in certain aspects of your sales process. And if let's say the foreign entity and the Australian entity are not connected, then we have to assess whether the Australian entity would remain viable on a going concern basis without its dealings with the foreign entity. Right. If you look at the first two questions, these first two questions triggered the application of MAAL. Right. After that, we have the purpose of the scheme aspect. I'm sure you guys have heard a lot about substance over form, right? Similar principle applies where we'll need to assess whether there's disparity between your contractual rights and obligations from the economic and commercial reality, right? That's very important. And the next question relates to the extent of contribution made by the Australian entity to the supply, right? First, of course, we need to look at what's the extent of the corporate contribution made by your Australian entity. To assess this, we'll need to look at the functions, assets, and risks performed by your Australian entity versus the foreign entity, right? For example, whether the Australian entity negotiates with the Australian customers, or does the foreign entity have direct contact with the Australian customers? So by going through this question, then you understand to what extent the Australian entity contributes and to what extent the foreign entity contributes, right? And which leads us to the next question, which is, has an entity connected with the scheme obtained tax benefits from it? I guess as has mentioned by Shannon and Kevin, tax benefits, it's the key to MAAL, right? Or simply whether its tax liability has reduced due to the scheme. Right here, we can assess whether there's any tax concession enjoyed by the foreign entity, which reduces the tax on the income from sales to Australian customers. So which means any type of tax arrangement that potentially reduces the tax on the income from Australian sales should be looked at, right? Then lastly, would be whether foreign tax rate is lower than Australia's, obviously. So these are the 6 framing questions that you need to go through to assess your MAAL risks, to make sure that if you look at, if you tick yes or no, that will be a likelihood of whether MAAL applies, right? Then of course, let's after this, let's conclude our key takeaways for today's session. Right. So basically, first you need to review your business model and transfer pricing structure. You should perform, I would say, internal review across the group for similar scheme into Australia. You should assess your risks and exposure to MAAL by going through what we've gone through, the MAAL risk assessment. And then next, we should consider adopting a proactive approach to manage your MAAL risks by either a voluntary disclosure, or you should have an open discussion with the ATO, or undergo a TP planning and restructuring exercise so that you understand your supply chain for the group with respect to these schemes. And lastly, of course, would be to actually maintain good transfer pricing documentation. It's very important to have a robust functions, assets, and risks analysis across your supply chain if you have similar schemes. So that's where we understand your overall structure, your overall supply chain in respect of these schemes. And then, of course, to support and document the low value activities performed in Australia. Right, thanks.
Great, thanks for that, HC and Kevin. But the key takeaway is definitely very important, and we've seen that many times. We've worked with a number of clients that fortunately most of ours have been situations where they're wanting to more proactively manage the MAAL situation, fortunately not having been the question side as much yet. But it is important, and especially as advisors or CFOs or tax directors here in Australia, a lot of our foreign, say, parent company colleagues may not be aware that we have these particular rules here in Australia, and they are quite unique. There is something similar in the UK. So really, how we can help with 2 parts on really kind of assisting you with the risk assessment for your MAAL exposure. So having a look at your current situation, looking at where you might have an exposure, or whether you can support it from looking at the commercial factors on it, estimation of the financial or tax exposure from MAAL and what that might mean. So that helps management to kind of make an informed decision as to whether they want to implement any changes. If you do have that situation where the ATO has knocked on your door, we can facilitate and assist you through that process. But also with planning, restructuring and implementing a study to mitigate some of the MAAL exposure that you've got, and transfer pricing documentation for the penalty protection. And really what we're looking at is understanding actually, I guess, that the law is there, and that this is something that will be reviewed. And I think that's probably the biggest thing that we've found, that once a taxpayer knows about it, we're able to assess it. It's those that are, I guess, not aware that this law has been around for a few years now, and the ATO is getting a bit more active on it. The ATO gets a lot of data coming in because of the international dealing schedule and the country by country reporting. So it's something that's being exposed to more, and I think we're going to see more questions coming out from the ATO. So hopefully this gives you a little bit more of a background. We will be sending out this webinar and also our slides. If you've got any questions, let us know. We do have another upcoming webinar. Feel free to give us another topics. If you've got some other topics you'd like us to touch on. We're going to go through the international dealing schedule update, a bit of the tips and tricks, I guess, for the international dealing schedule. We're scheduled at 14th of July, but for those of you in Melbourne, you'll probably understand the word lockdown and how that delays holidays because no one else lets us in around the other states around Australia. So we may have to delay that a week because we'll be on holidays potentially if they let us out. We may delay that a week given that COVID's kind of restricted a lot of travel for us. So if I've got any questions, if you'd like to ask any questions, we haven't actually had any questions come through yet. Is that a good sign, or that we've answered everyone's questions, or that it's a very confusing topic? But the key is, I guess, and if anyone does have any questions, I think the key is to be aware and make sure if you do see, as we've touched on during the webinar, when should you be considering whether the MAAL applies and what might be some of those trigger areas to look into to make sure that you have proactively considered the situation and that it's not, and that also that the foreign management are aware of the MAAL law so that it's not coming as a surprise at all from that perspective. Do we have any other questions? Is there anything else? No? Well, I think we can, oh, there we go. Now we've got a few coming through. Okay, yeah. Yeah, so we've got, when the ATO makes compensating adjustments, will there also be a GST issue? I guess on that one, I'd have to have a look at that situation. I'm not the absolute GST expert, but I think that you would be looking at, I guess, your timing on the transaction and whether you could make such an adjustment on that side. I think that one I'd have to look at further because the GST, I'd have to look at that, what that issue is. We have another one, having considered it and that it might apply, how do we go about mitigating it? I guess with about mitigating is actually going through the steps that HC had talked about and being able to put your file together to actually show that you don't have, in a sense, a MAAL issue because you haven't entered into a scheme for the benefit of achieving a tax benefit. So that kind of putting that documentation in place to actually, and it can be for some of the clients that we've worked with, that this is how they operate, and they operate like this in all the other countries around the world, and this is not, Australia is no different, and it wasn't entered into because of a particular scheme, but this is just the approach that's taken from an operational perspective. So it's about making sure that you're able to document and you've got the facts behind you on that. Right. Any other questions? Anyone? No, we've still got a lot on there. So feel free to go on. We'll be putting this up onto our YouTube. You can like and subscribe, and each time that there's something coming up. There's quite a lot of webinars we're also doing in Singapore as well, and in Malaysia as well, especially Malaysia's got new transfer pricing rules. So there's quite a number of those coming up as well. But if you have any questions at all, please feel free to reach out and we'd be happy to help you out. And thanks very much, everyone, for joining. Thank you.
Thank you.